Thanks for joining. Today I would give you some ideas what type of strategies hedge funds are using. As we discussed in one of the other videos, hedge fund type of investment fund that pools money from institutional investors, but also high net worth individuals. So you need to be accredited. And hedge funds in general is considered alternative investment, but it's not so much about the assets that are invested in. It's more about the strategy. So a hedge fund is a fund that invests in a variety of underlying assets, equities, bonds, real estate, infrastructure, commodities, and so on. But it employs different strategies. It uses leverage, short selling strategies, sometimes quite active and aggressive strategies. There's limited regulations, and especially you require quite a high minimum investment. So not everyone can invest in hedge funds. And also how the hedge funds make money. There's a management fee and a performance fee usually. And it's an active managed fund. Yeah, so that's about a hedge fund in general. Different hedge funds have different strategies. So in general, we see 5 different strategies. The first one is called equity hedge strategy. And here the focus is mainly on shares/stocks. And the hedge fund uses some sub-strategies. And that's where the name originally comes from. When we say hedging means long and short positions to hedge risk. But today, hedge fund strategies are not all about hedging and long and short positions. As you will see, there are different strategies. But originally, the name hedge fund comes from the main focus of long and short equity, meaning you buy undervalued stocks long and shorting overvalued stocks. There's another subcategory under equity hedge funds, which is short buyers, which means the hedge fund primarily short sells stocks, which they expect to decline. And then, as you hopefully have learned in another video, the hedge fund would make money. Another sub-strategy is called market neutral. This is really about balancing long and short positions to basically cancel each other out to reduce market risk. Then there are hedge funds out there that use more event-driven approaches and strategies. And here the idea is to make profit from corporate events. Corporate events could be M&A, bankruptcy proceedings, special situations like spin-offs. So the idea here is you look out for what is happening in the market. Is there an event happening soon? For example, mergers and acquisitions. And then when we talk about merger arbitrage, it's basically profiting from stock price movements in mergers, acquisitions. For example, have a long position in the target because we expect the target to increase in share price, but maybe short sell the acquirer to make profit. Then you have some distressed situations, investing in bonds of companies facing bankruptcy or restructuring to make money and see there is a share price change due to this situation. Then we have other special situations like exploiting unique corporate events like spin-offs and buybacks and to make use of those events. And then many times, you may know it from news, there are some activist hedge fund that actually take very large stakes in companies to influence the management and make the company better. Then the third category is called relative value hedge funds. Here, the main idea is to exploit price inefficiency. As you know, the market is not fully efficient, so exploit pricing inefficiencies between related securities. We talk about convertible bond arbitrage, trading bonds convertible into stocks, taking advantage of price mismatches, or fixed income arbitrage, again, exploiting mispricing in bond markets, selling, buying in different timings, and then multi-strategy, combining different relative value strategies. So it's all about looking at inefficiency in the market and see which kind of instruments we can buy and sell at different points in time to make a return. Then we have some opportunistic hedge funds. There it's really about observing market trends and macroeconomic changes. You may know Ray Dalio, one of a big hedge fund owner. He's all about macro investing, market trends. So here we talk about global macro investing based on currencies, interest rates, inflation changes, and make use of those changes, or managed futures, which means using future contracts to bet on commodities, currencies, and market movements. And then the last one, so-called multi-manager hedge funds. So you find hedge funds that are not solely focused on one of the strategies earlier. So here it's basically diversification across multiple hedge funds or strategies. Sometimes we call it funds of funds, investing in multiple hedge funds for diversification. So you can even see that one hedge fund invests in other underlying hedge funds for diversification reasons. Yeah, so hedge funds can become quite complicated, different strategies, depending on what the purpose and strategy of a hedge fund is. It's all about incorporating more aggressive, more creative ideas, short selling, leverage, activistic engagements, and so on. So that's why it can become a bit more complicated. But however, I want to give you an overview of those 5 broad categories. I hope you found this useful, and I see you in another video. Thank you so much. Bye-bye.